Welcome back to Real Estate Economics weekly webinar series. This week we're covering San Diego County. This is section 4 of 5 covering home prices and valuation. This particular slide shows median home prices going back to 1990. As you can see, the early part of the 90s values were very flat in this area. In fact, by the late part of that particular decade, we could demonstrate, for those of you who've read our residential economic reports, that housing was significantly undervalued here, maybe by as much as 50 to 60%. Rapidly, beginning in about 1999, home prices escalated. The job base was growing very rapidly here. The housing stock was not, as we've shown in previous slides. So well before any sort of subprime event started to take place, there was significant, dramatic appreciation in this particular market. As we mentioned in the last section, this market tends to go in and out of cycles, probably 18 to 24 months ahead of the region. So you can see here, by 2003 and 2004, values have ramped up, part because they were so undervalued 4 or 5 years earlier, but also because we have a rapidly growing job base at that point, and the only outlet for that demand, as we mentioned earlier, was through price. A little bit earlier than the rest of the region, by 2007, the market's rolling over a little bit. In 2008, it's in a full downward adjustment. So if you go out to the forecast period, we're at about 375,000 median home price now, but if you look at the balance of the forecast period, by 2014 we've shown some healthy appreciation in this market. It seems implausible now, but as the economy gradually gains its feet and we start to see some job creation, there'll be considerable appreciation take place here. This particular slide shows median home prices on an annual basis for an entire year. So if you look at 2010, we're showing 3.3% appreciation. I think that's probably already baked in the cake at this point. Many markets are performing lower, but the high demand areas and key pockets have already been appreciating at higher rates than that. If you look through the middle of around the year 2000 here, this market had a good 10-year run or 8 or 9 year run at least of double-digit appreciation, only to give nearly all of that back in 2008, continuing to suffer in 2009. We start to come back towards long-term appreciation rates in 2010, 11, 12, and then accelerate in the out years. Here's our housing valuation slide. The green line is supportable median home price, and what that takes into account is local incomes for the MSA and interest rates are all factored into the green supportable median home price line. Then the blue is the historical median home prices up into the forecast period. So those are actual numbers up until the current date, and then it's forecast out. These have tended to correlate pretty well over time. During periods of significant economic expansion, the price tends to get a little bit ahead of itself, only to come back, oscillate back when jobs taper off a little bit. Now this big shark fin looking shape you see here beginning in about 2004 is generally correlated with our subprime issue and people being able to qualify for a much more expensive home than their income would support. The only way that excess demand has to go out to the market is through prices, so prices quickly become disconnected from the earning power of the borrower, and that accelerates really until it reaches unsustainable levels and we start to have some sort of event that pulls it back to normal. Now this market significantly overcorrected, as you can see in this big blue drop-off that takes place in the blue line from 07 to 09. Now values are significantly understated. Values are too low for the current incomes in this area, particularly at current interest rates. If you see in about the late 2008 to 2009, there's a sudden jump up in the median supportable home price. That is when the government got involved in the mortgage market and rates went from about 6.0 down to about 5.0. literally overnight. That makes all homes in this area much more affordable on the same income. No differences in income really, just gradual growth. Suddenly homes become much more affordable. It's confidence and employment and other issues that are keeping the market from recognizing the undervaluation, and it takes several years to cure. So if you look at this market from equilibrium that we last experienced in January of 2002 out to a full run of the cycle here, it's more than 12 years. And so we've got a couple more years of significant undervaluation, which many rental investors and other people are recognizing. We see across the market area a lot of parents helping their kids buy homes and that sort of thing. Older people who've been through these cycles recognize the magnitude of the undervaluation and have been helping their kids buy homes in some cases. But in any event, it's a multi-year process to correct itself and return back to an equilibrium condition. Here it's measured another way. You can do calculations on this and see what the median supportable home is and that sort of thing, just like we saw in the last slide. And they're usually very close, as you could see here, till about 2003, when the market became significantly overvalued. By our measurement, more than 200,000. That's liar loans. That's people saying they made stratospheric amounts, way more than they did. And now we're paying that back as you come into 2008 and 2009. The market's seriously undervalued, and gradually people will begin to recognize that. Confidence will improve. People with jobs are out shopping now. People move in and out of the areas, but it is a long-term process, and this overvaluation is going to be in effect on the ground for a few more years here. Those of you who subscribe and read our market information are familiar with the Residential Market Opportunity Risk Report. This really lays out the economics behind the prices that are on the ground. I've shown here, we go back 20 years, but I'm showing here just a couple of years up into the forecast period in the far left-hand side of the graph. You can see housing demand. We talked to housing demand earlier in terms of employment, and we showed how those numbers came about. Housing supply, we talked about the size of the housing stock and how that oscillates against demand, driven substantially by employment, and that allows us to calculate whether or not the market is over or underbuilt based on the relationship between jobs and the size of the housing stock. You can see that from 2006 in the blue and the red. We were significantly underbuilt in 2006 and 2007 because the employment market was strong and supply grows quite slowly, as we've talked to. Now, coming forward, as the economy unravels a little bit and the employment situation turns much worse, we become overbuilt, and it's going to take a few years for this economy to straighten itself out and for the jobs to grow back into the size of the housing stock. Moving to median home price, those are real numbers up until the forecast period, in which case our analysis and our work takes over. You can see the annual price change that we just saw year over year in a previous chart. So for 2010, we've got 3.3, growing through the forecast period and really accelerating in the out years. Next is equilibrium home price, which we can calculate based on incomes and interest in that particular area. You can see in this slide, 2008, the equilibrium home price was $440 at 6.04% interest and a household income of about $62,007. 1 year later, with a cut in interest rates from 604 to 504, you get an additional $63,000 in equilibrium home price because the rates have gone down and incomes have gone up a little bit. As you can see, our interest rate forecast goes higher. We'll talk to that in a bit. But overall, the market is currently undervalued through the forecast period with strong to stable conditions on the ground. On the far right-hand side of the chart, you can see the market health in 2 years. So let's look at the 2008 data. We've got an improving market during the course of this year with an underbuilt and undervalued condition. Doesn't feel like it right now, but that will increasingly be manifest once we get just a little bit of improvement in the job environment. That's our part 404, so there's one section left if you want to hear all, and that will begin momentarily.